Did you know that your federal employee benefits got a little bit better in 2025? Well, if not, then make sure you're staying tuned for this video. I am Micah with Plan Your Federal Retirement. And we've spent a lot of time talking to federal employees about their benefits, some wonderful things, some pitfalls that are out there, mistakes that federal employees make before retirement. Man, if you haven't seen those videos, make sure you go back and watch those. I don't want that to be you. But in today's video, I want to talk a little bit about the great changes that are taking place in 2025. And great news, there are some pretty cool things taking place that affect your benefits. Now, remember, inside of your benefits, you have three pieces of your federal benefits, right? You have your FERS pension, you have your Social Security, and you have your TSP, your thrift savings plan. Those are the three legs in your three-legged stool. Now, your pension, the great news is nothing has changed in that. You get the same great pension that you have. I know there was some fear they were going to make some changes, negative changes to the pension. None of that took place. So you still have the same wonderful pension. It's based on how long did you work for the federal government times 8%, and then it's times your high three, your highest 36 consecutive months of pay. So your pension's still going to be there. The Social Security, not many changes have been made to Social Security. That's another good thing. You're still going to have an opportunity to turn your Social Security on sometime between 62 and 70 years young. The sooner you turn it on, the less it's going to be, the more penalty you're going to have. The longer you wait, the greater your Social Security is going to be. It's a cash flow game, right? Not everyone is the same, but this is something you really have to look at. I think people underestimate the significance of turning Social Security on early versus maybe waiting a little bit longer. So make sure you're well educated in that. And the last bit of your benefits that we're going to talk about today is that third leg in your stool, which is your thrift savings plan. Now, your TSP is great, and there's been a lot of changes to it, which are pretty nice. And so I want to get into those changes. But before I forget, the best benefit you have as a federal employee is your health insurance, your FEHB. Now, with your health insurance, you probably saw health insurance premiums went up a little bit this year. So did mine, right? Outside the federal sector, health insurance also went up. Federal employees saw about a 13% increase on average in 2025. But some other things happen with that as well. If you're in an HSA plan, you know, I've talked about this a whole lot. I'm a big fan of health savings accounts. It's the downside is you got to be in a high deductible plan. Deductibles aren't too bad, but you got to be in a high deductible plan. And you open up for this HSA, this health savings account. And now as a family, you can put $8,500, a little bit more than that, $8,550 a year into these plans. If you're over 55, you get an additional $1,000 catch-up. That's over 55, you get an additional $1,000 catch-up. If you're single, you can put $4,300 in the plan. Again, over 55, you can also put that catch-up in as well. These are great plans to be thinking about. You can really sock a lot of money away pre-tax for a potential future medical payment that you're going to have to pay for medical expenses. So great news is if you're already in that HSA, make sure you up those contributions if cash flow allows it. Now, I want to transition, talk a little bit your TSP, which is a great benefit that you guys have. I love the TSP. It has its pitfalls like anything else, right? But it's really great for savings. One of the things I'm going to talk about is the additional ways you can put money in the TSP this year, which is kind of new. But before I do that, let's talk about a good rule of thumb. My rule of thumb is that we call it my 50-50 rule. Any new money, any unexpected income that you have come in, whether that is a step increase, whether that's a change in pay, whether it's a bonus, a COLA, whatever that's going to be, I love applying the 50-50 rule. Allow 50% to come in and hit the bottom line, a little bit of increase in lifestyle, do other things you like to do. The other 50% needs to go towards long-term savings. When you do that, you really help create a gap, which is really good. That means your savings continues to go up and your lifestyle doesn't go up as much. Where people get in trouble is all of a sudden their lifestyle exceeds their savings rate and they go into retirement and they need this much money in order to retire, but they only have this much money that's going to come in. This is when they create a problem. So the way to stay on top of that, one of the best ways is that 50-50 rule. Now, the TSP's made some pretty neat changes. I'm still teasing you with that. I promise I'm going to talk about them. One of the changes that they made, well, I should say the IRS updated their contribution limits. So now you can put in $23,500 as an individual, plus a $7,500 catch-up the year you turn 50 or older. So remember, it's the year you turn 50, not when you're 50 years old. So if you're born in December, in January, the year you turn, you can put in that catch-up contribution, and that's really cool. They also created this additional catch-up, which no one's really talking about, which is pretty cool, that if you're 60, 61, 62, or 63, only 60 to 63, if you're between 60 and 63 years young, you get to put an additional catch-up in. And instead of $7,500, it's $11,250. So for those years between 60 and 63, you can put in this additional $11,250. Not too many people are talking about this. So if you're in that range, you turn 60 within this year, make sure you increase that contribution, which is great. The other thing to think about when you're putting money in, where does it go? Right now, investments is a different conversation we can jump into. Let's just talk taxes for a second. You get the two options. You can do the pre-tax TSP, which I put money into it now. It lowers my taxes today. That always feels kind of nice. The money grows tax deferred, but when I pull that money out in the future, I have to pay taxes on it. When you have the second option, which is kind of my favorite, which is our tax-free option, the Roth TSP. We put money in there today. I have to pay taxes on that contribution today, so it does not lower my taxes today. That's the downside. But now all of that money grows tax-free, and now when I go to pull that money out in the future, it's 100% tax-free. What's the best option? Boy, I gotta say, everyone is a little different. Me personally, I make sure I put a lot of money as much as I can onto the Roth side, including doing Roth conversions every year, because I think it's that important. My clients that are retired or retiring, I'm doing the same thing, really recommending to them we look at the Roth and we try to balance it out. You don't need 100% maybe in the Roth and drain all the TSP, but we need a good balance. So it's something you should be doing in your financial plan if you haven't already. On that note, keep in mind, in addition to funding your TSP accounts, you can also put money in IRAs and Roth IRAs, right? Now, the total contribution that you can make to an IRA or a Roth is $7,000. That's total. So it'd be $3,000 in IRA, $4,000 in Roth or whatever combination, but the total is that $7,000 plus a catch up the year you turn 50 as well, an extra $1,000. Now, one of the things to think about if we're putting money in an IRA, boy, really there are some reasons, but there are not a lot of reasons to put money in a traditional IRA for that $7,000. Really, it's to look at a Roth IRA. Now, some people make what the IRS calls too much money. I've never seen too much money personally. Maybe you have, right? I've never seen it. But too much money, if your income is above $236,000 married filing joint adjusted gross income this year, that means you make, quote, too much money. You cannot directly contribute to a Roth IRA. We have to do this really cool backdoor Roth IRA in order to get the money in. There are some catches with it, so make sure you're really careful on that. Make sure you work with somebody competent that understands this to put everything through. So that's what I would recommend for things to look at for you guys for this year is how are you funding money in your TSP accounts? How are you funding money for your health insurance, your HSAs, etc.? Make sure you're taking advantage of it and make sure you're always applying that 50-50 rule. I know inflation's there. I know groceries are more. I know in the pocketbook at the end of the day, there's sometimes a little bit less money, but we're still going to be retired at some point in time. Are we being intentional about those decisions, saving money forward? If you have questions about how this applies to your situation particularly, then go to our website, planyourfederalretirement.com. You can sign up to meet with myself or one of our advisors and help answer your individual questions. Until next time, happy planning.